So, each and every single one of you is cordially and warmly welcome to our webinar series once again for FRG paper, Financial Reporting and Governance. Coming up today is another important discussions in your syllabus, in your curriculum. This is very important standards for all of us, irrespective of whether you are doing chartered or A-level or whatever. This is LKAS 1. Presentation of financial statements. Presentation of financial statements, very important. Now, this prescribes how the financial statements of an organization should look and what it should look like. If not for the standard of LKAS 1, so different people who used to prepare financial statements would have used different formats, and obviously there wouldn't have been kind of a consistency or uniformity in the financial statements, and that will reduce the ability of the comparability of financial statements. So, one particular entity, if not for LKAS 1, presentation of financial statements, each and every single individual who prepares financial statements has their liberty and the independence to adopt their own format the way they wish, and there wouldn't have been kind of uniformity and consistency, and that will make the comparability of the financial statements so hard. Obviously, some people will call it revenue, some people can call it sales, some people can call it income, and some people can call it equity, some people can call it net assets, some people can call it owners funds. So, different people can use different terminology which they think is correct, which they think is preferable, and when somebody wants to compare 2-3 organizations to make some investment decisions, even the country as a whole would have been in a problem, because when the central bank especially wants to peruse and scrutinize and read the financial statements for the development of economic policies, everybody would have been in a problem in the absence of kind of this consistency and uniformity in the presentation of financial statements. Now, this LKAS 1 standard brings everyone to a common framework, to a common platform, and you can't use the terminology the way you like. It has to be the standard terminology. You can't use any format as you wish, depending on your preferences, depending on your choices, depending on your requirements. It has to be a standard format, and everyone is supposed to stick to that particular format, whether it is the balance sheet, whether it is the equity statement, or whether it is the profit and loss, whether it is the cash flow statement. You need to stick to, we do not prescribe the format for cash flows in LKAS 1. We have another standard for that. So, now everyone has to stick to and comply to a common requirements in the preparation of financial statements. Thereby, we are enhancing this quality of comparability among the preparers, so that whoever who uses financial statements of similar organizations, different organizations in similar industries, or different organizations in different industries, whatever, across the world, there can be this harmony and the uniformity and consistency in the financial statement. So, that will, the main focus on this is to enhance the comparability, as I repetitively explained, and that is what we are going to learn today, LKAS 1 presentation of financial statements. Let us look at the scope of the standard first. Scope. Now, different enterprises are existing across the world. Some organizations are profit oriented, their main focus is to be profitable. Some organizations are there whose objectives are not the profits, their objectives may be something else, like social welfare will be their main focus. And some people, will have different business activities for which different terminology has to be used, or sometimes in addition to you preparing a set of accounts for a single business organizations, maybe you need to prepare a combined set of accounts. I can't say combined, we can call it consolidated financial statements for a group of companies. And let us see for which and which companies LKAS 1 can be used, for which and which companies LKAS 1 cannot be used, and that is what we are going to discuss under the scope of LKAS 1 presentation of financial statements. Now, the scope says an entity should apply this standard in preparing and presenting general purpose financial statements in accordance with Sri Lanka accounting standards, and let me highlight that term, general purpose financial statements. General purpose financial statements. And this is a term which is commonly used or very often heard among the accountants and among the people who prepare financial statements and the people among the people who use financial statements, general purpose financial statements. Obviously, you would have heard it before, but you may not know what it really means, and let me explain that first, why this is very important. This is a very fundamental concept that we should be aware of in LKAS 1, general purpose financial statements. And if you have the standard book, you can even refer to the standard book. Also, I have given the definitions in my presentations, my document. General purpose financial statements, referred to as financial statements, are those intended to meet the needs of users who are not in a position to require an entity to prepare reports tailored to their particular information needs. It's in my document as well. General purpose financial statements, these are those intended to meet the needs of users who are not in a position to require an entity to prepare reports tailored to their particular needs. Now, as we know, the users of the financial statements will be of a wider range, and we prepare the financial statements for the existing shareholders, we prepare the financial statements for the prospect shareholders, we prepare the financial statements for the employees and trade unions sometimes, and we also expect them to read the financial statements for various purposes. Now, if the employees want to see the benefits we will pay to the employees, or if the increments given to the employees during the current year are consistent with the profit increments. So, for that to be understood, the employees or the trade unions need to look at the financial statements. So, they will see a profit increase by 200%, but the salary increase during the current year is just like 10%, and they will not be happy. So, that is something that they are not happy about it. Why? Their performances should be appreciated by giving an increment which is consistent with the increments in the profits. Directors' emoluments, directors' benefits and their perks altogether, financial and non-financial, is increasing. Their benefits are increasing by 200%, whereas the profits have increased by 100%. That is not fair. So, the employees also need to look at the financial statements for various purposes, especially to understand their job security and to understand whether the benefits given to them are consistent with the performances of the business. And the Inland Revenue Department or even the central bank will make use of the financial statements of organizations. Why? Maybe they want to develop an economic policy for the country, and they need to pick information which they think is important by reading the financial statements of various organizations. So, we need to prepare the financial statements in a way that all the information requirements of all the stakeholders will be satiated and will be satisfied. And sometimes even a journalist will go through the financial statements of our organizations just for them to develop, write an article on our business for the business page. Or maybe sometimes the students of a university will go through our financial statements for an assignment given to them for academic purposes. The financial statements will be used. So, the users of the financial statements, though they have been categorized under the conceptual framework, can be taken into a very wider range of users. So, you need to prepare the financial statement not just to satisfy the information requirements of a selected party, but to satiate and to satisfy the information requirements of all these identifiable stakeholders. Now, the management of an organization, and let me be little specific as to what this management is. Say the board of directors. Board of directors or the management of the entity of the organization concerned are in a position to require the entity to prepare the reports tailored to meet the specific information requirements of the director board or the higher management. Now, if the director board wants to see the sales increments, and they can command the sales director or the sales manager, look here, I want this report by tomorrow morning, please make it, keep it on my table before I turn up tomorrow morning, and he has to do it. And if the director board wants to see the cash budget or the cash forecast for 5 years ahead, so they can command the people, the finance director, the finance manager, look here guy, I want to see the cash forecast for 5 years ahead, you must make sure that it will be on my table by tomorrow morning before I turn up tomorrow morning to the office. So, he has to do it. What I am saying is, of this, users of financial statements who are of a wide range, one particular category, so let me take that party out, director board, is a special party among all these users. Why are they special? Because they have the power or they can command, they are in a position to require the entity to prepare the informations, to prepare the statements tailored to meet the specific information requirements of the director board. So, they have the command, and if they want to see the balance sheet of a month, they can command. If they want to see the profit and loss of a particular month, they can command. If they want to see the cumulative profit for the period, they can command. And if they want to see the bank balance, they can command. If they want to see the variance analysis, they can command. And if they want to see the reasons for the variance analysis, they can command. But now, of the users of the financial statements who are of a wider range, the entire other stakeholders, everybody else, the rest of the users are the parties who are not in a position to require the entity to prepare the statements tailored to meet the specific information requirements of the other parties. Now, say for an example, a journalist. This poor guy wants to develop, this poor guy wants to write an article about our organizations to a newspaper, weekend newspaper, and this journalist cannot come and command the finance director, look here, I want this report, I want this information by tomorrow morning, please make sure that you will send it to my office by tomorrow morning. He does not have that right to command. And even the central bank, they do not have that power to command the entity to prepare the statements tailored to meet specific information requirements of the central bank. So will be the Inland Revenue Department, so will be the trade unions and employees, so will be the debtors, so will be the creditors. So as a result, LKAS 1 says general purpose financial statements are the financial statements intended to meet the needs of users who are not in a position to require an entity to prepare reports tailored to their particular needs. So there can be so many people, so many parties who are not in a position to command an organization to prepare financial statements aimed and tailored to meet and to satisfy specific information requirements, and that is what. So those are the parties for whom general purpose financial statements are prepared, and these general purpose financial statements will be prepared for these parties who do not have the power to access to their specific information requirements in the business. I hope that was clear. So this is a very important concept to be understood in LKAS 1. So I took little time to explain the concept general purpose financial statements. I hope that would have been clear. Then you would have seen an annual report. In the annual report, are there many reports included? And please do not take the wrong end of the stick. The annual report is not the financial statements. The financial reporting in the annual report is only just a part of it, just a component out of it. Apart from the financial reporting included in an annual report, there can be some other reporting, non-financial report. So there can be some value-added statements, which is not part of the financial report. And there can be reporting on CSR. There can be reporting on environments, environmental reporting can be there. Or there can be reporting on non-financial reporting, integrated reporting. We will take all of them together, integrated reporting. Now, financial reporting is the reporting for which SLFRSs and LKASs will be applied. That has to be clearly understood. Now, SLFRSs and LKASs, in common we will call them collectively SLFRSs, will be applied only for the financial reporting, not for any others. And we have so many disclosure requirements specified by SLFRSs, LKASs, let me call them SLFRSs in common, only for the financial reporting. So that understanding is important. For integrated reporting or for CSR, for environmental reporting or for the other non-financial reporting in the annual report, you need not to apply SLFRSs. What are the accounting standards we need to use in preparing financial statements? Before that, let me get back to the scope. I could not complete that part. Please, I just wanted to explain the concept of general purpose financial reporting, and we will get back to the scope. The scope is where you learn which financial reporting LKAS 1 can be used for. Now, as I said, you can make use of LKAS 1, preparation of financial statements, when you prepare the financial statements, general purpose financial statements. Now, we have another financial reporting, we call it interim financial reporting, interim. interim financial reporting. What do you mean by interim financial reporting? Normally financial statements are prepared for a specific period, which is 1 year's time. If an entity decides or chooses to prepare financial statements for a period which is less than 1 year's time, that is called interim financial reporting, for which we have a specific separate accounting standard LKAS 34. Now, sometimes the format specified by LKAS 1 also can be used for interim financial reporting. There are instances where the specific structures of financial reporting prescribed by LKAS 1 can be also used to do interim reporting as well, but we will discuss separately about interim reporting in LKAS 34. Certain business enterprises will have to prepare financial statements for a period which is less than 1 year's time. There either you can make use of LKAS 34 or you can make use of still once again LKAS 1. Now, sometimes if an organization has to pay taxes on quarterly basis, before you decide your tax obligations, maybe you need to prepare the profit and loss and the balance sheet. And if you decide to prepare the profit and loss and the balance sheet of the financial statements for a period like a quarter, that becomes interim financial reporting. Why? That is a period which is lower, which is smaller than 1 year's period. We are moving on. So, as I said before, a non-profit organizations and organizations whose objectives are not making profit also can adopt LKAS 1 for their financial reporting, subject to certain changes in terminology. Why? They can have income, they can have expenses, and if the expenses are lower than the income, normally we used to call it profits. But their intentions is not the profit, their intentions will be something else, like say social welfare. Then without calling that the net profit or loss, they can call it the excess. LKAS 1 can be adopted by even non-profit making organizations, subject to changes in the terminology, or maybe sometimes certain changes or modifications in a way that the financial reporting formats fit into their requirements. Then, as I said before, even group of companies can make use of LKAS 1 for the preparations of consolidated financial statements, no issue. So, that is the scope, and then let us move on to the balance. So, the financial statements are prepared in accordance with SLFRSs in common. We call them SLFRSs. Some standards are in the name of SLFRSs and some standards are in the name of LKASs. We will call them SLFRSs in common. And in addition to SLFRSs, LKASs, also we make use of IFRICs, or we make use of SICs, or we make use of statement of recommended practices. Statements of recommended practices, and we have a SOAP for the consolidations of entities under the common control. Those who do that would have learned it before. And also we have statement of alternative treatments. And we also have interpretations adopted by, I have taken that before. And also we have financial reporting guidelines issued by the Institute of Chartered Accountants, Sri Lanka. Now, you know, for an example, if you want to determine deferred taxes for a business enterprise for which tax holidays have been granted, nowhere does LKAS 12 specify how the entity for which tax holidays have been granted should recognize deferred taxes, and that is given by a separate guidelines issued by CA Sri Lanka. So, those are the entire set of pronouncements or CLFRSs which are adopted in financial reporting, and these are what we are using for general purpose financial reporting. So, you need to have an awareness of all these. You learn all of these in your curriculum, part of your curriculum, may not be everything, but you learn SLFRSs, you learn LKASs, you learn IFRICs, you learn SICs, you learn SOAPs, you learn SOATs, and you also learn guidelines issued by CA Sri Lanka on financial reporting. Purpose of financial reporting. Purpose of financial reporting, and we have done it even in the conceptual framework. Those who watch the videos of webinars relating to conceptual framework would have watched it, would have learnt it. The purpose of financial statements is to provide information about the financial positions, financial performance and cash flows of an entity that is useful to a wide range of users in making economic decisions. LKAS 1 also acknowledges a second important role of financial statements, that is that they also show the results of management stewardship of the resources entrusted to them. It meets this to meet this objective, LKAS 1 requires that financial statements provide information about an entity's assets, liabilities, equity, income, expenses including gains and losses, contributions by owners and distributions to owners in their capacity as owners, and cash flows. Stewardship. What do you mean by this stewardship? Stewardship. Now, that is a philosophical concept which you need to be aware about. Now, this is like the second objective, or it is like a byproduct of the financial reporting, stewardship. Now, the financial reporting is like a process to which there will be input, and that is the transactions and events, and the output will be the financial statements like the profit and loss and the balance sheets and the cash flow statements and so on and so forth. On the other hand, we know this is the entity, and there are various people who contributed resources to this entity. We will call them the shareholders for the moment, the people who contributed to the capital of the company, shareholders. Shareholder 1, shareholder number 2, shareholder number 3, number 4 and so on and so forth, right. Now, they have contributed to the capital by say 100 million rupees, and this entire 100 million would have been used to finance the purchase of the assets. Now, the shareholders themselves will not be the controllers of the company taking the decisions relating to the operations, and that is entrusted to another set of people. We will call them the directors or the management. Directors. This is the principal agency theory. So, the directors have to utilize the resources given by the shareholders in a way that the return to the shareholders can be optimized, not only for the shareholders, the latest concept is the stakeholders. The resources given to the company are entrusted to the directors of the company in a way that these resources should be used in a way to optimize, to maximize the return to all the stakeholders of the company. Now, if say for a small example, if you give some raw food items like rice, like say coriander, like chili powder, like salt, like eggs, for someone to prepare a meal, and the preparation of the meal has been entrusted to a chef. How tasty the final meal depends on how good this chef is in his culinary science. And if the chef is someone like me who does not know anything about culinary science, he just mix all these up and give something like a, it's like a kanji. And that is not the expectations of the person who gave him the raw food items. But if you give that items of raw food items to eminent chef who can prepare mesmerizing, who can prepare mouth-watering, who can prepare scrumptious foods in the world, that is like the chef, the person to whom the resources were entrusted, trying to give the maximum return to the owners of the materials. That is like the chef or the person to whom the materials were entrusted, trying to optimize the return back to the owners of the materials. So, now the director board will be like the chef to whom the materials were given, and the shareholders are like the owners of the materials, and these directors who are the chef in the organization, chef in the kitchen, has to prepare a mouth-watering meal to the shareholders, not only for the shareholders, for all the stakeholders, to satiate their hunger of profits, to satisfy their hunger of the return, the hunger of the profits, the hunger of the dividends, and that will be reported, that is reported from this financial reporting, and that is also another secondary objective of the financial reporting, management stewardship, how good they have been in utilizing these resources to give the maximum return to the owners, how good the management, how effective the management has been in utilizing the resources to optimize the return to the stakeholders of the entity, and that is also reported from this financial reporting. We call it stewardship, an important concept. So, what do we report from the financial reporting? Assets, liabilities, equity, income, expenses including gains and losses, contributions by owners and distributions to owners in their capacity as owners, and cash flows. Now, we will get into the contents of LKAS 1. If you see the lineup of the matters to be taken for the discussions in LKAS 1 is the financial statements, fair presentation, going concern, accrual concept, materiality and aggregation, offsetting, disclosures of comparative informations and consistency. So, those are the items lined up in our discussions, and we will take one by one in our detailed discussions. Now, it will not be in the exact order, but we will discuss all of them in our discussions of LKAS 1 in this video. Frequency of reporting and period covered. How frequently should we report? How frequently should we prepare financial statements? And if not for LKAS 1, various people who prepare financial statements would have started reporting for different periods. Some people will report on 3 months period, some people will report on 6 months period, some people will report on 9 months, some people will report on 1 year, some people maybe once in 2 years, some people on ad hoc basis. Whenever they want to prepare, they just do it, and whenever they want to pay taxes, they start being active, they start rolling their sleeves up and start preparing financial statements. Once again, if you compare the financial statements prepared for 3 months of an organization with another set of accounts prepared for 6 months of another similar organization, financial statements of 3 months are never consistent and comparable with the financial statements of 6 months of another organization. We will think of an example. Say company A and company B. Company A and company B, and both of them are in agriculture business and they have mango plantations. Company A will prepare the financial statements covering from 1st January 2020 right up to 30th June 2020, 6 months. And company B will prepare the financial statements starting from just for 3 months period, starting from 1st July to 30th September. And the profitability of company A will be far more higher than the profitability of company B. Why? They have prepared financial statements for the period during which they get the highest crop, highest harvest. All the mango trees will start bearing fruit during the month of April and May and June. So, they have the highest profitability, and they would have had the same profitabilities for the same period, but those guys are preparing the financial statements after getting and receiving the highest crop. So, this financial reporting for this period is not comparable and consistent with the financial statements for company B. Now, the frequency has to be 1 year's period. So, let us look at it now. LKAS 1 requires that a complete set of financial statements including comparative information be presented at least annually. However, LKAS 1 mentions that the end of an entity's reporting period may change, and that the annual financial statements are therefore presented for a period longer or shorter than 1 year. Normally, it is not a hard and fast rule. I mean, you have to be consistent in preparing financial statement. You need to follow the requirements. Normally, annual financial statement should be prepared, but there can be ups and downs either way. Sometimes there can be exceptional instances where financial reporting period can be longer than 1 year or can be shorter than 1 year. There can be pluses and minuses either way, subject to certain requirements. What are the requirements to be adhered to? When this is the case, if an entity prepares financial statements for a period which is either longer than 1 year or shorter than 1 year's period, then the entity has to disclose the reason for using a longer or shorter period, you need to give the reasons. Just because you have the desire to prepare the financial statements for a period which is longer than 1 year's time, you are not permitted to do it, you need to explain the reasons. And the fact that the amounts presented in the financial statements are not entirely comparable. Now, as I said before, we prepare the financial statements covering for 15 months, and all the other enterprises in the industry have prepared financial statements for a year. And we know the profit of 15 months will be way more bigger than the profits of 12 months. Your financial statements are not straight away comparable with the financial statements of other similar enterprises. So, you need to explain, you need to disclose that fact. You need, if you prepare the financial statements for a period which is either longer or shorter than 1 year's time, you need to disclose two aspects. What are these two aspects? You need to explain the reason. Also, you need to state the fact that these financial statements will not be entirely comparable, and subject to those requirements you are permitted to use a reporting period which is either longer than 1 year's time or shorter than 1 year's time. Then we will move on to general features. General features. Fair presentations and compliance with SLFRSs. Financial statements should present fairly the financial position, financial performance and cash flows of an entity. Fair presentation requires the faithful representations of the effects of transactions, other events and conditions in accordance with the definitions and recognition criteria for assets, liabilities, income and expenses set out in the framework. An entity whose financial statements comply with SLFRS shall make an explicit and unreserved statements of such compliance in the notes. An entity should not describe financial statements as complying with SLFRSs unless they comply with all the requirements of SLFRSs. The following general principles must be considered when preparing financial statements: fair presentations, going concern, accrual concepts, materiality and aggregations, offset and disclosures of comparative information, consistency, right. Fair presentation, we will call it also faithful representation. Faithful representation. In other words, if you make it further simple for someone to understand, fair presentations or faithful representations mean the financial statement should be reliable. Someone should be able to have faith on our financial reporting, and your financial reporting should not be a fake, it has to be genuine. And this is an important area. We discuss and talk about faithful representations more in the conceptual framework, but not in LKAS 1, but LKAS 1 also re-emphasizes the requirement of the financial statements being presented fairly and to faithfully represent the effects of events and transactions. How can we do it? This is what you need to understand, this part is important. So, they are to be a faithful representation, faithful representation, faithful representation. The items of incomes and expenses, assets, liabilities and equity recognized in the financial statements should be the only assets, liabilities, equity, incomes and expenses which the conceptual framework requires us to recognize. And the items of assets, liabilities, incomes, expenses and equity would have been valued the way the conceptual framework requires us to value them, and then only your financial statements are faithfully represented. I do not think you got it right. So, let me take some illustrations to explain that. Now, you cannot dump any damn thing in the balance sheet saying these are our assets. The assets, all the assets we show in the financial statements, the balance sheet should comply and should fall in line with the definition of assets in the conceptual framework. So, what does the conceptual framework say the assets are? An asset is an economic resource arising from a past event, arising from a past event. It is an economic resource arising as a result of a past event. And if you want to recognize an asset into the balance sheet, you must make sure the value can be determined reliably and it has to generate economic benefits and the entity has the control over it. Control, the entity has to have the control over it. So, the conceptual framework as far as assets are concerned specifies the definition. How does the conceptual framework specify what the assets are? Assets should be an economic resource arising as a result of a past event, and for you to recognize assets, you must make sure the value can be measured reliably and that generates economic benefits, and the entity must have the control over it. Now, the reporting date is 31st December 2020. Sometimes back, a customer, a very good customer who has been with us for a long time, has filed papers against the company, accusing the company for providing defective goods, and the customer is claiming compensations of, let me take the other way, and we have filed the papers against our suppliers for providing us defective goods, and we are claiming compensations of 100 million rupees. And the case is just filed. Even our lawyers who appear in our favor in the magistrate haven't still gone through the case in detail. Still, our lawyers are not in a position to give us an opinion how the judgment will be delivered, whether it is on our favor or in favor of the other party. Now, despite of all these facts, our entity will decide to show 100 million rupees as a compensation receivable. It is an asset. For you to show that in the balance sheet as an asset, you need to make sure that fits into the definition of an asset in the conceptual framework. Just because it is an asset, not that all the assets that fall into the definitions of the assets can be recognized unless the recognition requirements are not satisfied, unless the recognition criteria are satisfied. Is it an asset? Let us look at the definition. For that to be asset, please make sure it is an economic resource arising from the past event, there is a particular event that triggers the asset. What is the event, very event that creates, that triggers this asset? That is the court judgment. If the courts will decide and order our suppliers to pay us compensations, that is the very event that will trigger the asset, and then only we can recognize the asset. Until such time the court decides that the supplier should pay us compensation, the event that triggers the asset has not occurred, then 100 million cannot be an asset because the past event has still not occurred. Then if you show this asset in the balance sheet, first and foremost, it is not an asset because it does not fall into the definition of asset. So, the asset that you show in the balance sheet is not a genuine true asset, it is a fake asset. Then faithful representation is not there. Our financial statements are not fair, our financial statements are not trustworthy, our financial statements are not something on which someone can keep the faith on, and we are giving fake information, we are lying in the financial statements. Faithful representation is not there. On the other hand, you cannot recognize into the balance sheet, you can't show it in the balance sheet. Why? You do not have the control over the asset, you cannot control the asset. Why can't you have the control over the asset? It is the magistrate who will decide whether we should receive the compensations or not from the suppliers. You cannot bribe the judges in the magistrate, influencing them to give us the verdict and the judgment in our favor. You cannot give them a call on the previous night, influencing them to give the judgment in our favor. So, it is not within our control, it is beyond our control. If the asset is not controllable, if it is not within our control, once again you cannot recognize it into the balance sheet. Once again you have made another mistake of recognizing an asset which does not satisfy the recognition criteria. So, once again something which is not truly an asset has been shown in the balance sheet as an asset. So, we try to inflate our assets, we try to exaggerate, we try to show the assets with pretensions, we try to inflate our net assets, and this is not fairly presented. Nobody can rely on our financial statements, nobody can keep faith on our financial statements. We lie and we provide fake information, so financial statements are not faithfully represented. And so should be liabilities, so should be income, so should be expenses. So, let me take another simple example for income. Now, SLFRS 15 specifies how revenue should be recognized, that is the standards relating to revenue recognition. Say we have a simple transaction of selling goods to an overseas customer. On 1st January, I will say the reporting date is 31st December 2020 is the reporting date. Exactly on the reporting date, we export some goods for a value of 5 million rupees. We have invoiced in US dollars, its rupee equivalent is 5 million rupees. And this is on CIF basis, cost, insurance and freight. Then the customer will be collecting the goods at his port in USA, America on 31st March 2021. SLFRS 15 talks about recognizing revenue when 4 or 5 steps are, you need to look at 5 steps in recognizing revenue, and we can't explain those 5 steps. We have done SLFRS 15 video, you can watch it. If you apply SLFRS 15, the point at which the seller should recognize revenue is the point at which the control of the goods transfers to the buyer. Where the goods are invoiced on CIF basis, the point at which the control of the goods passes to the customer is the date when the customer collects the goods at his hub, at his port, that is on 31st March 2020. But this company, despite the requirements of SLFRS 15, decides to recognize revenue on 31st December 2020, the date on which the goods were loaded to the ship and the vessel of the exporter. So then this entity recognizes a revenue which is not a true revenue, it is not a genuine revenue. So they try to pretend to show that we have recognized a revenue which is not a genuine revenue, and they are inflating revenue, exaggerating revenue, and their profitabilities are wrong. So they are showing fake profits. Why? The revenue they recognize is not a revenue as per SLFRS 15. So as a result, the financial statements are not trustworthy, it is not fairly presented. It's not fairly presented, it's not trustworthy. Nobody can keep faith in our financial reporting. So now, for you to faithfully represent from the financial statements the effects of your transactions and events, please make sure that the items of assets, liabilities, income, expenses, equity are the items which fall into the definitions of the conceptual framework, also are the items of assets, liabilities, equity, income and expenses which satisfy the recognition criteria of the conceptual framework, and then only the financial statements are faithfully represented. In short, your financial statement should be reliable unless you show assets, liabilities, income, expenses, equity which are fake. The components of financial statements. Components of financial statements, components. You learn components of financial statements, also you learn elements of financial statements. The elements are assets, liabilities, income, expenses, equity, and the components are something else. Let us look at what the components are. According to LKAS 1, presentation of financial statements, a complete set of financial statements has the following components. The statement of financial positions, in our normal day-to-day language we call it the balance sheet, but true name is the statement of financial position. Next, the statement of profit or loss and other comprehensive income, or statement of profit or loss with a separate statement of other comprehensive income. You know, either the profit and loss and other comprehensive income can be combined into a single entity, or you can have two separate statements. Profit and loss can be one statement and other comprehensive income statement can be a separate statement. So that is not an issue. It has to be kind of a accounting policy. A statement of changes in equity, a statement of cash flows, accounting policies, notes and other explanatory notes, and these are what that will constitute a complete set of financial statements. And if the cash flow statement is not prepared, do the financial statements become a complete set of financial statements? No. And if you are not providing, a complete, if you are not providing the explanatory notes and accounting policies as part of it, do the financial statements become a complete set of financial statements? Not. And I just forgot to explain one small point in the previous one under general features. Let me do it and then come back to this. When you prepare the financial statements, you need to disclose, or there has to be compliance with SLFRSs, and you must make an explicit and unreserved statements that your financial statements are in full compliance with SLFRSs. Those two words are important: explicit and unreserved. Explicit, this is very open. Unreserved, unconditional. Now, you cannot make this statement unless you comply with all the reporting requirements of all the SLFRSs. Now, you can't say that we have prepared financial statements in accordance with SLFRSs except for the requirement of the inventories being valued at the lower of cost and NR. Then it is not it's not unreserved, it is conditional, subject to LKAS 2. And you can't ever say that we have prepared the financial statement subject to all SLFRSs, in compliance with all SLFRSs, subject to the financial assets through OCI being fair valued, being valued at its fair value. Then it's not an unconditional, unreserved statement. It is subject to statement. So, you should include the statement that the financial statements have been prepared in compliance with full SLFRSs. If you complied with all the requirements of all SLFRSs, it cannot be a subject to statement, it cannot be a conditional statement, it has to be unconditional statement saying that we are in full compliance and we have adhered to all the requirements of all the SLFRSs. Then the statement in the financial statements becomes an unreserved statement. It has to be explicit, open. You cannot just imply, you cannot just indicate. You need to speak to the face. You cannot beat about the bush. You should come to the point straight on. Say, a girl has fallen in love with a boy, and the girl wants to transform her romantic feelings into words in front of the boy. The girl can sit by the side of the boy and say, look here, so and so, or someone. I think I can't ever think of a life without you till the God closes my eyes. That statement is not explicit, that is implicit. I think I have started thinking of you more than I am thinking of myself. I think I have started speaking about you with my colleagues with more than I speak about myself with my colleagues. What brings tears your eyes are what brings tears to my eyes. What brings smiles to your face are what brings smiles to my face. All these are what? Indications of something. It's not an explicit statement, that is an implicit. But if she says, I love you straight away, without beating about the bush, that is an explicit statement. So, the statement that the financial statements are in full compliance with SLFRSs cannot be implicit, it cannot be just an indication, it cannot be just an implication. It has to be a straightforward, direct statement, say that we are in full compliance with SLFRSs, and it has to be unconditional. If it is explicit, if it is unreserved, then only we can include that in the financial statement, saying that our financial statements are in full compliance with SLFRS. I hope you got it. Now we get back to the complete set of financial statements. It is the financial statement of financial position, statement of profit or loss and other comprehensive income, and statement of changes in equity, statement of cash flows, accounting policies notes and other explanatory notes. Then identification of financial statements. Financial statements usually form only part of a larger annual report, regulatory filing or other document. As SLFRS LKAS only apply to financial statement, it is important that the financial statements are clearly identified so that users of the report can distinguish information that is prepared using SLFRS LKAS from other information that may be useful but is not subject of those requirements. LKAS 1 also requires that each financial statements and the notes be identified clearly. Furthermore, the following is required to be displayed prominently and repeated when that is necessary for the information presented to be understandable. I said before, your financial report is just part of your annual report, and you need to give informations enabling the users to distinguish your financial reporting from other non-financial reporting. Why? SLFRS LKAS apply only for financial reporting, not for the other non-financial reporting. So you should be able to provide adequate indications, informations enabling the users to distinguish financial reporting from non-financial reporting. Normally, the following, these are important, the following should be displayed prominently. You should be able to see it prominently. It has to be displayed prominently, these facts, and it has to be repetitively displayed prominently, not just in one page, in every page of the financial reporting. The name of the reporting entity or other means of identifications. You know, if you have done company accounts, if you prepared financial statements for a company, maybe for academic purposes at the exams, or maybe for your client place, or maybe for the entity itself for which you work, you can see the name of the entity is given prominently so that anybody can see it. Whether the financial statements are of an individual entity or a group of entity. APLC, say the statement of financial position, APLC, what does it say? We are giving and preparing, presenting this statement of financial position for a single entity. But you can say consolidated statement of financial position for APLC group, then you try to indicate prominently to the readers that the entity for which we prepare the balance sheet is not a single entity, it is going to be a group of entities, consolidated balance sheet. The date of the end of the reporting period or the period covered by the set of financial statements or the notes. Say the statement of financial position of APLC as at 31st December 2022. You would have seen this. The end of the financial reporting has to be given. The date of the end of the financial period has to be given. Then the presentation currency. towards your right hand, you would have seen that the currency in which the financial reporting is done is indicated, shown prominently, rupees, and this is the function of presentation currency determined in accordance with LKAS 21. Presentation currency has to be shown. Then the level of rounding used in presenting amounts in the financial statement should be shown. Say the figures are in thousands, you would have seen this, or the figures are in millions, you would have seen this, and those are the basic informations to be shown in the financial statements, and those informations need to be prominently shown repeatedly in every page in your financial reporting. So, of these financial statements, now let us come to the statement of financial position. The statement of financial position. The statement of financial position. Now, on the face of the financial statement of financial position, what information is to be shown? And some people will decide I should not show investment properties. Why? Some people will decide I should not show inventories on the face of the statement of financial position. Some people will decide I will not show debtors on the face of the statement of financial position. And you cannot decide on your own the information that should be presented in the balance sheet, in the statement of financial position, should be specified, has been specified by LKAS 1, the minimum information, the informations to be presented, the minimum requirements of presentations of informations on the face of the balance sheet statement of financial position has been specified by LKAS 1, but then from this minimum requirement you can go into detailed levels. You can make the presentations as detailed as you think is sufficient for the readers of the financial statements, but you cannot go below the minimum requirement of presentation. As a minimum, the statement of financial position should include line items that present the following amounts. Property, plant and equipment should be shown. Investment property should be shown. Intangible assets should be shown. Financial assets should be shown. Investments accounted for using equity method should be shown, that is investments in associates or joint ventures. Biological assets should be shown. Inventory should be shown. Trade and other receivables should be shown. Cash and cash equivalent should be shown. The total of assets classified as held for sale and assets included in disposal groups classified as held for sale in accordance with the SLFRS 5 should be shown. Trade and other payables should be shown. Provisions need to be shown. Financial liabilities need to be shown. Liabilities and assets for current tax should be shown. Deferred tax liabilities and deferred tax assets need to be shown. Liabilities included in disposal groups classified as held for sale should be shown. Non-controlling interest presented within equity should be shown. Issued capital and reserves attributable to owners of the parent company should be shown. So, those are the minimum requirements, and you can't decide that we should not show property, plant and equipment in the face of the balance sheet. Why? It is a minimum requirement. But you can decide whether to show the detailed analysis of the property, plant and equipment as part of the notes or right on the face of the balance sheet, that is up to you to decide. But you cannot decide not to show property, plant and equipment in the balance sheet. Why? Then you violate LKAS 1. A complete breach of violations of LKAS 1 will result the financial statements not being faithfully presented. Now, if I just give you a simple example why this minimum information presentations is required. Say property, plant and equipment, investment properties, intangible assets, even some of the financial assets can be grouped together under non-current assets. And somebody will think of showing the total of non-current assets in the balance sheets and to wash their hands without giving separately the items of property, plant and equipment, investment properties and intangibles. You cannot just dump the total value of non-current assets in the balance sheet and wash your hands. Why? The minimum requirement of information to be presented on the face of the statement of financial position is specified by LKAS 1. What is the philosophy behind? Now, we will forget about investment properties. Say we have property, plant and equipment and intangible assets. Property, plant and equipment 70 million, intangibles are 30, altogether non-current asset 100 million. Now, you are presenting the balance sheet financial statements to a bank requesting a finance facility. Just because you start sitting in front of the bank manager and start smiling by showing all your uneven yellow color big teeth, it does not mean that the bank manager will be impressed to give you a loan of a big value, of a significant amount. And you are proving your financial strength. Balance sheet was given. Total non-current asset 100 million. The bank is asking you to offer the bank a security. It has to be an immovable property. Now, just by looking at this total of non-current assets, the bank does not know, the bank cannot understand whether this company has properties to be offered as a security to the bank. But if you give this division of property, plant and equipment and intangible assets, now the bank to some extent can understand that this entity has some properties to be offered as a security to the bank, so that the bank can be little positive about granting the loan. And elsewhere in the financial statements, property, plant and equipment analysis has been given where buildings are shown separately, the lands are shown separately and the vehicles are shown separately, the machineries are shown separately, and the lands are 50 million rupees. And also we have explained freehold lands. Now, the bank manager need not to keep ringing you, asking this information, that information. Why? The informations in the financial statements are detailed enough. The informations in the financial statements are detailed to the required and enough levels so that the bank can pick the required informations by the bank itself without ringing and asking the informations from you. So, that is why these minimum information requirements are specified by LKAS 1 to satisfy the information requirements of all the stakeholders, not just the shareholders only. assets, you can see a distinction of assets into non-current assets and current assets. And these are not something to be by-hearted. There is a philosophy and a science to be learnt behind all these. And that is where the importance is. You just memorize, no use. Understand the philosophy and the rationale behind these concepts, and then answering the questions at the exam is not so hard. Now, the balance sheet total say 100 million. 100 million. We recognize impairments. So, what has got impairment to do with LKAS 1? That will be your $1 million question. It is like this. If you buy an asset at 10 million rupees, you cannot show this 10 million asset value in the balance sheet unless the assets will contribute at least to a minimum 10 million cash flow over its useful life. In other words, assets in the balance sheet cannot be carried. Assets in the balance sheet cannot be carried at no more than its recoverable value. If this asset does not contribute to at least 10 million cash flow, you cannot show 10 million asset value. If this asset will contribute to 100 million cash flow, asset value 10, this is the price you paid to buy, and you can show 10 million rupees. The expected economic benefits, the expected recoverable or the cash flows of the asset should be always bigger than the carrying value, and that is a requirement. But if for some reasons the assets cash flows recoverable values will be 9 million rupees and you have no chance to show the asset at 10 million rupees, and as soon as you got to know that the future cash flows will be lower than the carrying values, you need to bring down the asset value from 10 million rupees to 9 million rupees. Then by showing 100 million asset value, we give a guarantee to the readers. What is it? This company or this business will contribute to at least 100 million cash flows in the future. And if you want to sell the business to another party, a business valuer will not place a value for this business below 10 million rupees. Balance sheet value has to be the minimum guaranteed value. If you do the share valuations in finance management, you know balance sheet value has to be, the net assets value has to be the minimum or the guaranteed value for the business. Nobody can ever put or place a value for the business below the net assets balance sheet value. Then of this 100 million, 30 million has been under current assets and 70 million has been under non-current assets. You make these informations more useful to the readers now. Basically, this business will contribute to future cash flows of 100 million rupees. And you make this information to the readers more important and more valuable by showing how soon we can collect the cash flows. Out of 100 million, 30 million can be collected within 1 year by and large, and out of 100 million cash flows, 70 million minimum cash flow can be collected during the period beyond 1 year's time. Wow, what a presentation. Not that we decided to show the distinctions between current and non-current just for the sake of doing without a reasons, and there are reasons. what assets are we going to show under current and what assets are we going to show under non-current. And LKAS 1 clearly makes a distinction between current and non-current assets, and let us see what and what can be shown under current and what can be shown under non-current. So, there are basically 4 kinds of assets to be shown under current assets category, 4 assets. If it is an asset which is to be realized or consumed during the entity's normal trading cycle, and this does not apply for all the organizations, let me talk about it in a little while. If it is a trading organization, there can be a trading cycle. What do you mean by the trading cycle? When you start the business at a scratch, you have a cash balance of 100 or 10 million. So, you do not have a cash balance. And you are a manufacturing entity, not a trading entity, manufacturing and trading. What happens is, you need to buy the materials from your suppliers. It was 10 million rupees, so you have creditors of 10 million. Then you have materials, inventories. Inventories are 10 million. And those raw materials inventories will become work in progress now, work in progress. They are neither raw materials nor finished goods, they are in the process of being manufactured. And the work in progress will become finished goods then, finished goods. The finished goods are sold to the customer, so the finished goods will become debtors now. And debtors will pay us money, and then you will collect your cash balance, and the cash will be paid to creditors. So, this is a cyclic process, and this keeps turning always, and then only the business keeps moving forward. And this is your trading cycle, the creditors, the inventories, the work in progress, the finished goods, the debtors and the cash, and so on and so on. That keeps moving, that keeps turning. And if it is an asset to be consumed or to be realized in your trading cycle, inventories are the assets to be consumed in your trading cycle. Work in progress are the assets to be consumed in your normal trading cycle. Finished goods are the assets to be consumed in your normal trading cycle. Debtors, wow, that's not an asset to be consumed, but that is an asset to be realized in your normal trading cycle. And that is what that will make you recognize inventories under current assets, work in progress under current assets, finished goods under current assets, debtors under current assets. Why? They are the assets to be realized or to be consumed in your normal trading cycle. So, if it is an asset either to be realized or to be consumed within your normal trading cycle, without being hesitant, categorize it under current. Why? That is what LKAS 1 wants you to do. Second, if it is held for trading, if it is held for trading, if it is an asset held for trading in the entity, categorize it under current assets category. What is an example? Under financial instruments, you have fair value through profit and loss financial assets. And basically those are the assets acquired for speculative or trading purpose. If the value is 10 million rupees, you put it under current assets category. Why? Assets held in the entity for trading purpose should be current assets, or an asset to be realized within 12 months of the reporting date. Now, the entity had given, we are now on the reporting date 31st December 2020. Entity had granted 5 million worth of staff loans. Staff loans portfolio 5 million. And the entity sometimes supports the employees who does not have a sound and a strong financial background. Then what happens is, the entity has a policy of recovering all the staff loans just within 6 months time or maximum 12 months. Say, let us say it is maximum 12 months. The loan was granted 5 million, is 5 million. This is to be recovered in 12 months time. So, this entire 5 million has to be categorized under current. Why? It is an asset to be realized within 12 months time from the reporting date. And let us say we have 5 million loan granted on 31 December 2020, and this is recovered monthly over 24 months time, over 2 years time. Come on, how are we going to do the distinction between current and non-current? The number of or the values of the loan to be recovered within 12 months time from the reporting date should be categorized under current, and the number of installments or the value of installments to be recovered during the period beyond 1 year's time should be under non-current category. Then the fourth one to be recognized and shown under current is the asset is cash or cash equivalent. To know what cash and cash equivalent, you need to go to LKAS 7 and you can watch the videos very soon. LKAS 7, the cash flow statement, statement of cash flows. Cash or cash equivalent should also be recognized under current assets category. So, there are 4 kinds of assets to be recognized under current assets category. What are those 4? The assets to be realized or to be consumed within the normal trading cycle. The assets held in the business normally for trading purpose. And the assets to be realized within 12 months time from the reporting date. Assets that are cash or cash equivalent are the assets to be recognized under current. Anything else, any other assets except for these 4 items should be under non-current, So, what to be recognized under non-current category is based on what to be categorized under current category. So, that is important to be noted. And there is one exception. If you happen to recognize deferred tax assets, So, you have brought forward unused tax law, carry forward unused tax losses or deductible temporary differences. The deferred taxes you recognize should be deferred tax assets. And please remember, it is very important, make it a permanent fixture in your memory. Remember it, never do we show deferred tax assets under current category. It has to be always under non-current category. If you ever recognize deferred tax assets in a balance sheet, please make a note of it. Never do we put it under current category, it has to be always under non-current category. So, should be deferred tax liabilities. If you happen to recognize deferred tax liabilities, never does it come under current liability, it has to be always under non-current liability category. Similarly, When it comes to liabilities, as far as liabilities are concerned, and even the liabilities have a distinction between current and non-current. Some liabilities are under current category and some liabilities are under non-current liability category. So, how do we make the distinction? This is very much similar and consistent to the distinctions of current and non-current assets. Now, if it is a liability to be settled during the entity's normal trading cycle, now I took the same example before. Say we have creditors. So, they are the parties whom we purchase the goods on credit from. The creditors are a type of liabilities to be settled in your normal trading cycle. Put it under current category, not non-current. I just forgot to tell you something under current assets. Now, inventories. Now, examiner can be smarter. The examiner studies a lot about the students. The examiner knows the weaknesses that the students do, and that is where he capitalizes. Always your enemy, the examiner will be attacking to the weakest point. If you are in a war and you are attacking to the enemy to their weakest point. Likewise, the examiner has studied the students well. He has a very good proper broad understanding of the students. He is attacking to the weakest point of the students, and he can set a question like this. Now, inventories, we are now on the reporting date on 31st December 2020. And we have inventories of 100 million rupees. And given the nature of the manufacturing process, some inventories will be consumed not within 12 months time, some inventories will be consumed during the period which is beyond 1 year's time. Now, inventories we purchased are not just for 1 year's time, and we have once and for all purchase inventories for 2 years. So, out of 100 million, 50 million inventories will be consumed within 1 year's time, and the balance 50 million inventories will be consumed beyond 1 year's time. Can the inventories to be consumed beyond 1 year's time be recognized under non-current category? That can be a question. No. Why? The assets to be consumed in your normal trading cycle should be current irrespective of whether those assets will be consumed within 1 year's time or beyond 1 year's time. Similarly, debtors. We have sold 100 million worth of goods on an easy payment scheme, and we have given the customers an extended prolonged credit period of 5 years. 100 million will be collected. 100 million will be collected over 5 years time, or just say 2 years. Now, since debtors, it is debtors, not for any other assets, debtors. Why? If it is another loan, the classification can be, this is debtors. Debtors are the assets to be realized within the normal trading cycle. So, irrespective of whether we will collect within 1 year's time or beyond 1 year's time, you can classify it under current category. If it is another asset which is not to be realized within the trading cycle, say staff loans, it is not to be realized within the trading cycle, then you need to classify partly under current and partly under non-current. I hope you got it. Then the liability is to be categorized under current if it is settled during the entity's normal trading cycle. I have taken creditors as an example. Held for trading, I will explain that in current assets. It will be settled within 12 months of the reporting date. I have said explain that under current assets category, current assets. Now, accrued expenditure, it comes under current. Why? It is to be settled within 12 months time. Tax payable, current. Why? It is to be settled within 1 year's time, 12 months within the reporting date, from the reporting date. And the fourth one is very important. The entity does not have a right at the reporting date to defer settlement of the liability by the transfer of cash or other assets for at least 12 months after the reporting period, and that part is important. Suppose the reporting date is 31st December 2020. And we have a loan payable, and this has to be paid on 31st December 2025 in 5 years time. But when this loan facility was granted by the bank, there was a precondition, so there was a requirement. What was it? The bank said, you need to maintain your gearing level at 40%. And if the gearing level rises above 40%, you should immediately pay us the loan. So, the loan value is 100 million rupees. We will not be waiting until 31 December 2025. You immediately become liable to pay the loan if you do not maintain your gearing level at 40%. So, we have agreed and signed. Then every time we go for a debt, we have to do the calculations. Are we within the stipulated limit? For some reason, you had to go for another loan, and the gearing level rose from 40% to 50% now. And our banker who granted us 100 million rupees said that you have violated your loan covenants and you become immediately pay the loan to us, not in 5 years, you have to pay us immediately, and the bank can demand it immediately. Then you need to recategorize it from non-current category to current category 100 million. Why? The entity does not have a right at the reporting date to defer settlement of the liability by the transfer of cash or other assets for at least 12 months after the reporting period. You do not have the right to defer. You become immediately liable to pay that. So, that was the fourth one, which is the most important one. Under current liabilities. The assessment of a liability as current or non-current is applied very strictly in LKAS 1. In particular, a liability should be classified as current A, when it is due to be settled within 12 months after the end of the reporting period, even if the original term was for a period longer than 12 months and an agreement to refinance or to reschedule payments long term basis completed after the period end and before the financial statements are authorized for issue, or when an entity breaches a provisions of a long term loan arrangement on or before the period end, with the effect that the liability becomes payable on demand. This is the case even if the lender agreed after the period end and before the authorizations of the financial statements for issue not to demand payment as a consequence of the breach, although the post period an agreement would be disclosed. The standard explains that the liability should be classified as current because at the period end the entity does not have an unconditional right to defer its settlements for at least 12 months after that date. However, the liability would be classified as non-current if the lender agreed by the period end to provide a period of grace ending at least 12 months after the reporting period, within which the entity can rectify the breach and during which the lender cannot demand immediate repayment. Right.